There is a lot of bad tax strategy and advice that goes out on the internet. Here's what I've seen from some of my successful clients who have had exits and how they have legally minimized capital gain taxes on a business sale. Hey everyone, I am Andrew. I'm the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. I've spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. And what I do is I give the learnings from those situations to you so that you can apply them to your own situation. Can you hear that bird? That's insane. The first thing you need to understand when you're trying to minimize gains on a business sale is, what is the actual game you are playing? Meaning this, and I've had this several times, where somebody says, hey, I got a letter of intent from a PE firm to buy my business, and it's for, I'm making up numbers, $10 million. And I say, great, what's your basis in the business? And they go, my accountant's working on that. And the accountant doesn't actually get them their basis until like 15 days before the sale. You cannot do any good planning if you don't know that information far up front and before an LOI has been signed. And I'll explain why here in a second. You need to know, are these actually capital gains? Is it, I've injected $1 million of capital into the business and it's $9 million of capital gains? Or is it a business where you have inventory and some of that inventory is counted as ordinary income? Are there accounts receivables that are going to be pro rata distributed on sale? Is there an escrow that the buyer wants you to maintain and that you're earning interest income over time? Will that be ordinary income or capital gains? Do you have real estate? Is there depreciation recapture with that real estate? You can see how multivariate this gets and how complex it gets very quickly. My first ask to you is, please understand the game you're playing. If you don't know how you will be taxed, you cannot mitigate the tax. Okay? Now, let's assume it's capital gains taxes. You can affect the tax liability in a few different ways. And the first way is by timing. Okay? And you reduce the tax with timing most easily, if it's a private sale, through something like an installment. I've seen this with private business transactions selling to next gen people many times, where, for sake of example, let's assume you have $1 million business and you do a 5-year installment sale on it and you have zero basis in the business. Why would you do 5 years? Well, if you are married filing jointly, capital gains tax, you can see the bracket up here where it is just like our ordinary income system. It's a marginal tax system. There's a 0, a 15, and a 20% capital gains tax rate. Furthermore, there's something called the NIIT, net investment income tax. That is a 3.8% Medicare surcharge that, if you're married filing jointly, anything over $250,000 hits that additional NIIT tax. There's minutia with it, but for sake of our discussion, let's leave it there. If you have $1 million of gain in a business and you installment sale it over 5 years, you then have a $200,000 pro rata long-term capital gain each year. Okay, so you're now paying a lower than 15% effective tax rate because some of the long-term capital gains are taxed at 0. You're avoiding the 20% capital gains tax rate, and you're avoiding the 3.8% Medicare surcharge. Now, that's an ideal scenario, and there are risks to the installment sale. The biggest of which being, it's essentially a seller-held note. And so you can sue the person if they default on it. If the collateral was the business and now the business is not doing well, you either have to take it back over and build it back up, which I've actually seen before, or your collateral doesn't really post anymore, so you lose out, right? So it's essentially a seller finance transaction, but depending on the confidence of the buyer, the confidence you have in the buyer, it can be a way to mitigate taxes over time. And you don't have to structure it equally. You can have a balloon payment in there. There's interest income that comes because there has to be a note. There has to be essentially a loan and interest rate with it. The AFR, it's the minimum rate of interest that you can charge somebody. So you could even charge them 6, 7, 8% on the note because they're not having to do bank financing to buy the business, right? So the first way to minimize taxes is through the timing of the sale. The second would be through the structure of the sale. And a really good example for this is real estate. So many businesses have real estate attached to it. And if I've seen it once with businesses, I've seen it 50 times where a private equity firm comes in, they want to buy the business, and the person just assumes, well, they're going to buy my real estate with it. And the problem with that is many times they've really depreciated out the business, maybe even done some cost segregation on it to take advantage of that. And so if the real estate was worth $1 million, they may only have a basis of 100 or 200,000 in it. And then you have a depreciation recapture tax, right? You can avoid that through something called a 1031 exchange, which is where you say, I know that this real piece of real estate is getting purchased. I can buy a like kind piece of real estate. Many times it's investment property. And there are parameters with it. The big ones that you would need to know for our purpose today is there's a 45-day identification period where you have to identify a property. And there's a 180-day closing period where you have to close on the property. The problem is it's really hard to find specific properties that match the fair market value that you want, right? You're really limiting your scope of investments, and you're having to identify very, very quickly what you want and close very quickly on what you want, which many times leads to suboptimal investment performance long term because you're rushing things, right? Rather, what I've seen be just as, if not more effective, is telling the private equity firm or whoever's buying your business that comes in, hey, I will sell you the business, but you're going to rent from me, and I'm going to maintain the real estate. And you just structure the deal that way. And so by doing that, you can now say, hey, I'll do a triple net lease, and it's going to be a 10-year lease, and every 3 years we're going to have a jump with CPI of the rent. And, I'll maintain the parking lot or what. There are many different ways you can structure it, but that way you're getting the liquidity from the business. Now you're getting rent roll, okay? And you're getting to maintain the depreciation over time. And it gives you the time and ability to figure out, do I want to continue to own real estate long term? Or do I just want to be done with everything? I think it buys you time and optionality. It avoids you having to pay the taxes in 1 year, like you otherwise would have to if it was all purchased. And it avoids the quickness with which you would have to identify a property with a 1031 exchange. So you can affect the timing of the taxes you pay. You can affect the structure of the deal itself. And then the third way is through loss offsetting and charitable giving, is what I would say. On loss offsetting, what do I mean by that? If you know the sale is going to be capital gains in the future, and you have an inkling, I'm probably going to sell my business, which most people do at some point in their career, you need to make sure your investment strategy of your marketable investments is aiding you towards that end, not hurting you. And so some things that may not be suitable for the vast majority of people might be suitable for you. Things like really aggressive tax loss harvesting strategies, where you're not even trying to offset gains in your portfolio. You're hardly realizing any gains in your portfolio, and you're doing, anytime the market goes down a few percent, capturing that loss. Even doing things like direct indexing, right? Instead of holding VOO, the S&P 500 ETF, you're owning a representative sample of the stocks within the index, and that way you're getting 300 or 400 opportunities to tax loss harvest on a security level basis and a tax lot level basis rather than just the ETF. And you can even go so far as to say, I want a long short direct index where I have a long part of the portfolio, but I also have shorts in the portfolio that are generating losses, and you get a longer runway and you get higher tax loss harvesting as well. If normal tax loss harvesting gives you, and the data's all over the place, if normal tax loss harvesting over a 10-year period gives you maybe 50 basis points of tax alpha, depending on your tax rate, how aggressive in the market regime, direct indexing may give you close to 1%. Long short direct indexing may give you 1.5%, right? And so each of these ratchet up different risks and different costs. But depending on your business sale and what you're trying to achieve, it could make sense to have a very aggressive posture towards tax loss harvesting and banking those losses for over time so that you can offset that. Furthermore, what I've seen some people do is that if they know I'm going to want to give some piece of the profits from this sale, so some people tithe from their business sales. Let's say for a second that your business was worth $1 million, but at sale it's going to be worth $10 million, and you want to give 10%, right? If you wait till it's worth $10 million and you give away $1 million, you've paid tax on $10 million. And if you put $1 million into a donor advised fund, you get a deduction on your tax return, but you're essentially saving, 23.8 cents on the dollar plus tax or plus state tax. You're saving your marginal tax rate, which in this example is going to be your long-term capital gains rate plus Medicare surcharge plus your state income tax rate. So it's anywhere in the 23 to maybe 30% range. What you could do instead, if you know I'm going to be giving part of this away, and the book value of the business before a letter of intent is $1 million, I give 10% of my shares of the business to a donor advised fund. And then whenever the sale happens at 10 million, now I'm only reporting a $9 million capital gain because 10% of the ownership is a donor advised fund, right? And so the $1 million still gets given to charity. I got a little bit of a deduction in 1 year. I didn't get as big a deduction, but I avoided the income. I avoided the capital gains on 10% of the whole transaction. And so you need to make sure your legal structure's able to do that, but it can be done with private businesses. It can be done with private real estate as well. And so again, the three things that you can do is you can affect the timing of the capital gains and how quickly it occurs. You can affect the deal structure and what you are selling, if you're selling the whole business and the real estate or just the business, and you can affect loss offsetting and then charitable giving in nuanced ways. So hopefully that gives you a few extra things to think about that you've probably not heard before. If I missed something or if you have a specific question about this, go to leverwealthmanagement.com/ask and I will personally answer your question. And until next time, thanks everyone.